In today's video, I'm going to break down a very important concept that a lot of people kind of struggle with, and it is liquidity and liquidity sweeps. Whether it's your first day trading or you've been trading for a while now, this video is just definitely going to give you a bunch of value and it's going to help you out. So first of all, what is liquidity? In trading, liquidity is very simple. It's resting orders. So I'm gonna draw it so that it's easier for you guys to understand what's happening. It's usually in places like highs and lows. Now, excuse my shit drawing, but yeah. Boom, okay. So as you can see here, we have a high that was formed, and then a higher high, all right? And a lower high here. Perfect. Zones of liquidity usually rest above highs. So, for example, here, or in lows, below the lows, which are here. For example, we have a low right here, another low right here, for example. All of these are zones of liquidity. Why though? Now we have to understand why. So why are they placed above highs and lows? Well, most traders put their stop losses, for example, above the last high. In that case, it would be, for example, let's say you were to take a trade. Most traders would put its stop loss right here. Or if we're going longs, they would put a stop loss below the lows. You see? They would put a stop loss below the lows. Those stop losses, these are areas of liquidity. So, for example, let's put it into context. Market is here. Boom, let's remove everything here. All right, perfect. So, let's say market forms a high. All right? Retail traders see this as a breakout opportunity. And they're like, okay, that's perfect. Let's go longs. They would take their trade, put their position here, their stop loss below the low, and take profit somewhere. Usually they're targeting highs or something like that. So because they have their stops here, this low now has a bunch of resting orders below, right here. So what does price do? Price usually seeks out to take out this liquidity. So what happens is we have these lows here, boom, price pushes down below that low and takes out all of these people that are in longs. What is it called? It's a stop hunt. So institutions, the smart money, they know this, obviously. And so in order to move the markets, they want to target these stop losses. So they will either use these areas of liquidity either as a place to enter a trade or to exit a trade. And so that will lead us to something called liquidity sweep. So just to give a quick recap first, liquidity, where do we find it? It's either on highs or lows, usually high time frame. It happens on all the time frames, but the significant ones and the important ones are usually on the high time frames. So it's either, for example, this high was a liquidity zone, it got swept, and this high now is an area of liquidity, as well as this low light right here, for example. These are areas of liquidity. So now liquidity sweep. What does liquidity sweep mean? Liquidity sweep is when a price moves down in a very, very aggressive move to sweep out these zones of liquidity. So it's like a swing high or swing low, for example, and then it reverses. So let's say we have here, let's say we have here a high, okay, and a higher high, okay. Market's moving a bit lower, and what happens? Boom, a sweep of liquidity, and then a break of structure. Where's the sweep of liquidity? It's here, on that high right here. Why? The market pushes up and takes out the previous high, for example, to trigger the stop losses for the people who were in short, and then it instantly reverses back down. And we had that strong move down followed by a break of structure. So that confirms that there was indeed a liquidity sweep. It's basically called a stop hunt, where the market manipulates, makes people think that, oh, we're going to go higher, takes out that high, for example, and boom, shits the bed. Big Drake candle to the downside. So now that we have kind of an idea of what it is, let's actually find it within the charts. Okay, yeah, I can already spot some very good ones. Perfect. So let's first, where is the liquidity? We identify it. We identify the areas of liquidity, which in that case is going to be the highs right here. So we had a high here, which is a high time frame high. We had some more highs here. Okay, these are high time frame highs. What time is it? That's a New York high. That's the Asia session high. Okay. What happened during New York? We went we swept out this area of liquidity, and then we had a big move down. Very simple. So we had the highs here and the highs right here. What happened? Big move up. We swept these areas of liquidity, these highs, all the resting orders right here, all the stop orders. We swept, then boom, big move to the downside. Let's find another example. It's very easy to find these. Even here, I'm pretty sure this is going to be an SMT divergence, but whatever. Okay, we'll get to that in another video. Where are the lows? Here. So this was a low. This was a low that happened in the Asia session. So this was a low right here. What happened? Price went up. Okay, we inverse that for value gap. People might think that, oh, we're going to go higher. What happens? No, price manipulates, takes out this low. So it takes out these areas of liquidity and creates a liquidity sweep by having a strong move up right after it. Okay, we had a strong move up right after this zone of liquidity. So to draw it out so that you guys can understand it in a much easier way, boom, we had the low, okay, and some price chopped here. This was the low right here, okay? What happened? Price moved down. So price moved down, took out this low, and then instantly moved up and broke structure to the upside. Very simple. We can find another example for you guys right here. Where's the high? The high right here. Let's mark out. So this is the zone of liquidity. Boom, price sweeps. As you can see, a wick, break of structure to the downside, and price shits the bed. It's very easy. You find it everywhere. You can find it on all the different time frames. And it's a very, very important concept because it's the foundation of the majority of smart money concept trading strategies. So the way you could execute off of it, you find a liquidity sweep and then a break of structure. You wait for a retrace on the 5-minute into a fair value gap or equilibrium. And then you would have a 1-minute continuation confluence and enter off of that. But it's very simple. I'm going to make another video just breaking down the other concepts. But this is it for liquidity. If you guys have any questions, let me know in the comments and I'll reply very, very quickly. See you guys.